Hello, today we will speak about PE ratio, why investors look at this indicator and how to use it in your investment analysis. Stay tuned. PE ratio is one of the most important indicators in company evaluation. Usually, it is useful to quickly understand how much money the investor will pay for every dollar of the company's profit. Low and high PEs can be an indicator that a company is under or overvaluated. PE is especially useful when you try to evaluate companies in the same industry. In this case, it will be more clear to you which company's stock is cheaper than another. You can calculate PE in two different ways. First, take the market cap and divide by total net earnings of the company for the past 12 months, trailing net earnings. Second, take the current stock price and divide by earnings per share, EPS. Let's take the example. Suppose the market cap of the company is 1 billion and net earnings including dividends are 100 million. In this case, PE ratio will be 10. 1 billion divided by 100 million. Speaking about other way of calculating, let's take the same company but add more numbers. Suppose that there are 10 million shares outstanding and the stock price is now $100. To calculate earnings per share, we need to take total net earnings and divide them by total shares outstanding. So 100 million divided by 10 million equals 10, meaning we get $10 of company net profit for every share we buy. This doesn't mean that we can get them. The CEO has the right not to pay dividends but reinvest them or buy back shares. So in this case we need to keep this in our head. Then to calculate PE we divide 100 by 10 and get PE of 10. Knowing these simple formulas, we can easily know all these numbers separately, like market cap or net earnings. This might come in handy when we need to quickly evaluate the company. If you analyze the company performance during its whole history, it can be useful to look for historical values of PE ratios. Sometimes it helps to understand the periods when the company was undervaluated or overvaluated. To look for historical numbers, you can go to Morningstar, find the particular company and look for the numbers. However, the data here is only for 3-5 years of company performance. If you want to look for more broad period, I personally recommend Macrotrends website or finviz.com. There you can search for particular ratios and see the chart for 15-30 years history of the company's performance. There is another website which you can use for your analysis. It was created by the professor who teaches corporate finance in the STEM School of Business at New York University. He took all companies listed on the stock exchange, more than 47,000, and classified them by industry and the sector. For every sector, starting from 1990, he has collected data and calculated all main ratios like current and forward PE, PEG ratio, expected growth, and other. I will put the link down in the description. Not every time high PE is bad and low PE is good. As I said in my previous videos, when you buy a stock, you buy a small portion of the company and become its owner. If the company is not growing enough, you will see it in its PE ratio. Let's talk about reasons why companies' PE can be high or low. There are some thoughts based on a philosophy of investments gurus like Warren Buffett, Charlie Munger, Manish Pabrai and others. If we compare buying the stock with buying the private business or startup company, you can pay more for the stake in particular situations. First, growth. If you understand that the business you are buying is growing at a decent rate every year, you will be willing to pay more for the company. Here we can add examples like Amazon, Tencent or Google. If the company produce a good return, not growing enough but have a durable competitive advantage, you can also pay more for that. The example here is Gillette and Costco. If you have great talented management on board, great operators and capital allocators, it will also be useful. Company like Amazon is a perfect example because they always have day one and test new ideas every time. Last but not least is an economy of scale. Maybe you have seen that most IT companies have high PE ratios. That's because investors believe that company can grow exponentially in revenue and profit after a critical mass. Low PE, on the other hand, can be due to different factors. First, high profit for past 12 months. When we look at the company with unusual profit, it is not always a sign of high growth. Because of trailing earnings in the formula, we only take the past 12 months into consideration. There can be situations when the company sold part of the assets to pay out debt or received one-time profit for their investments. So in this case, we should look at the whole picture, analyzing earnings in dynamics for 3, 5 or more years. There can also be situations when the stock price fluctuates. There can be also market misunderstanding. Mr. Market, this is how Benjamin Graham named the stock market, is a partner who frequently offers different deals. Let's take an example. You have a partner who came to you every day and offers to buy the share and offers to buy a share of the business for a particular price. One day he is full of happiness and the other day he is full of depression. As a result, one time the price can be higher and the next time it can be lower. You have the right to decline the partner's offer at any time and accept it at any time. So there can be situations when the company has a low PE ratio but has hidden assets or advantages which will be revealed by the market in the future, so the price will increase. The examples can be Amazon and Fiat Chrysler. Before the announcements of AWS in 2006, the company was not so profitable, and after 2006, net revenue grew from $190 million to $1.1 billion in 2010, 55% compounded annually. Let's talk more about how we can use this ratio to analyze the company. Usually, I look at the company PE and its competitors. Then, I look for the average PE in this industry and this sector. After that, it will be more clear if the company is better or worse than its competitors. Now let's talk about visible and hidden PE. Previously, I gave the example of Amazon. In the beginning, the company was not so attractive, but it had a great growth potential. There is a great investor, Manish Pabrai, who talks that we should look for hidden PE of 1. This means that we need to look for companies which can significantly increase their net profit in several years, so we get compound return of 25-26%. Hope this information was useful for you. Also, please subscribe to the channel for more videos. Bye!